They move $50 trillion every single day. That's more than the GDP of the United States and China combined, circulating constantly through just 5 firms. You've never heard of most of them, but they see everything. Every stock trade, every bond purchase, every derivatives contract worth hundreds of trillions of dollars. They don't just facilitate the financial system. They are the infrastructure. This is the story of the institutions that control the shadow banking empire, the clearinghouses, the custodians, the settlement systems that make global finance possible, and what happens when that much power concentrates in so few hands. The date is September 15th, 2008. Lehman Brothers collapses. $613 billion in assets vanish overnight. Panic spreads through every trading floor on Earth. But while investment banks implode and governments scramble, 5 institutions remain standing, untouched, essential, too interconnected to fail. Their names? Depository, Trust, and Clearing Corporation, Euroclear, Clearstream, State Street, BNY Mellon. They don't make headlines. They don't have charismatic CEOs giving TED Talks. They operate in the plumbing of global finance, processing transactions so fundamental that the entire system would freeze without them. Let's start with the biggest one, DTCC. The Depository, Trust, and Clearing Corporation. Founded in 1973 as a response to the paperwork crisis that nearly destroyed Wall Street 5 years earlier. By 1968, trading volume had exploded beyond anything the financial system could handle. Brokers were drowning in physical stock certificates. Deliveries failed. Settlements took weeks. The New York Stock Exchange had to close every Wednesday just to catch up. The solution was elegant. Centralize everything. Create one institution that holds all the securities and simply adjusts electronic ledgers when trades happen. No more shipping certificates across Manhattan. No more chaos. Today, DTCC processes nearly every securities transaction in the United States. Equities, corporate bonds, government securities, mutual funds. It settles $2.5 quadrillion in transactions annually. That number is so large, it becomes abstract, meaningless, until you realize it represents every stock you've ever bought, every retirement fund contribution, every corporate bond issuance, all flowing through one institution. DTCC's subsidiary, the Depository Trust Company, holds $87 trillion in securities in custody, not as an owner, as a custodian, a massive vault where ownership records exist electronically. When you buy Apple stock through your brokerage, you don't actually own a certificate. DTCC's records show your broker's nominee company holds it on your behalf. Layers of intermediation, all controlled by one central node. Across the Atlantic, 2 institutions mirror DTCC's dominance, Euroclear and Clearstream. Both born from the Eurobond market explosion of the 1960s, when governments and corporations started issuing bonds outside their home countries to avoid regulations and taxes, they needed a way to settle these trades across borders. Traditional systems couldn't handle it. Euroclear was created in 1968 by Morgan Guaranty Trust, which later became JP Morgan Chase. Clearstream emerged from the merger of Deutsche Börse Clearing and Seidel International in 2000. Together, they process $1 trillion in transactions daily. They hold $40 trillion in assets under custody. They connect more than 2,500 financial institutions across 120 countries. These aren't just back-office operations. They are the circulatory system of European finance. When Germany issues bonds, Euroclear settles them. When multinational corporations raise capital in Luxembourg, Clearstream clears the trades. When pension funds in Norway buy French equities, these institutions make it happen. And then there are the custody banks, State Street and BNY Mellon. They don't trade, they don't advise, they hold assets, safeguard them, process transactions, provide the administrative infrastructure that institutional investors need to operate. State Street manages $43.7 trillion in assets under custody and administration. BNY Mellon manages $48.8 trillion. Together, that's $92.5 trillion. more than 3 times the size of the entire U.S. economy. They serve as custodians for 95% of all assets in mutual funds. They process dividend payments, proxy votes, foreign exchange transactions, and securities lending. They are invisible to retail investors, but indispensable to every pension fund, sovereign wealth fund, and asset manager on Earth. Here's what makes this concentration extraordinary. These 5 institutions don't compete with each other in the traditional sense. They occupy different parts of the infrastructure. DTCC dominates U.S. clearing and settlement. Euroclear and Clearstream dominate Europe and international securities. State Street and BNY Mellon dominate global custody. Each is effectively a monopoly in its domain, and they're all interconnected. DTCC links to Euroclear and Clearstream to enable cross-border settlements. State Street and BNY Mellon rely on DTCC to clear U.S. transactions. The entire architecture is circular, self-reinforcing, a system where the biggest institutions become more essential over time precisely because they're already essential. This didn't happen by accident. It happened because of how modern finance works. Clearing and settlement require scale. Network effects. The more participants that join a central system, the more valuable it becomes. Fragmenting these services would create inefficiency, counterparty risk, and operational chaos. So regulators and market participants naturally gravitate towards centralization. But centralization creates vulnerability. Consider what happened on March 3, 2021. State Street's custody platform experienced a technical outage. For several hours, asset managers couldn't access data on $5 trillion worth of holdings. Trades couldn't settle, reports couldn't generate. The outage lasted less than a day, but it revealed how fragile the infrastructure is. One technical failure, one institution, billions of dollars frozen. Or consider the ransomware attack on Ion Group in January 2023. Ion provides software that clearinghouses use to process derivatives trades. When hackers encrypted Ion systems, they disrupted clearing operations at major institutions across Europe and the United States. Trades were delayed. Margin calls couldn't be calculated. The entire derivatives market, worth more than $600 trillion notionally, depended on one software provider. The financial system has become so efficient that it's brittle, so interconnected that it's vulnerable. And the institutions at the center of this system have become so large that their failure is unthinkable. Let's examine that power more closely. DTCC's National Securities Clearing Corporation settles virtually every equity trade in the United States. It uses a continuous net settlement system. Instead of transferring securities and cash for every individual trade, it nets out all the obligations between participants at the end of the day. This reduces the amount of capital needed to settle trades and makes the system more efficient. But it also means NSCC becomes the counterparty to every trade. When you sell a stock, you're not actually selling it to the buyer. You're selling it to NSCC, and NSCC is selling it to the buyer. This arrangement is called novation. It eliminates bilateral risk between individual counterparties, but it concentrates all that risk in one institution. In January 2021, this system faced unprecedented stress. GameStop's stock price exploded from $17 to $347 in 2 weeks, driven by retail investors coordinating on Reddit. Trading volumes surged, volatility spiked, and NSCC's risk management models calculated that clearing brokers needed to post billions of dollars in additional collateral to cover potential defaults. Robinhood, the trading app at the center of the frenzy, received a collateral call of $3 billion from NSCC. Robinhood didn't have it, so it restricted trading in GameStop and other volatile stocks. Retail investors were furious. Congressional hearings followed. But the fundamental issue was simple. The clearinghouse demanded collateral to protect the system, and when brokers couldn't meet that demand, trading stopped. This is the power these institutions wield, not through active decisions about who wins or loses, but through the mechanical enforcement of risk management rules that keep the system from collapsing. When volatility spikes, collateral requirements rise. When collateral can't be posted, access to the market gets cut off. The custody banks exercise power differently. State Street and BNY Mellon don't just hold securities, they vote them. When you own shares in a mutual fund or ETF, the fund legally owns the underlying stocks, and the custody bank that holds those stocks on behalf of the fund often votes the proxies. This matters because institutional investors now own more than 80% of the stock market, and 3 asset managers, BlackRock, Vanguard, and State Street Global Advisors, collectively manage $20 trillion and are the largest shareholders in nearly every major corporation in America. State Street, the custody bank, provides services to State Street Global Advisors, the asset manager, but they're separate entities within the same corporate structure. The result is that a small number of institutions have enormous influence over corporate governance. They vote on executive compensation, board elections, mergers and acquisitions, environmental policies, and political spending. Academic research has documented that these institutions tend to vote in similar ways, creating a block of coordinated influence that shapes corporate behavior across the economy. Some argue this is benign, that these institutions vote in the interest of long-term value creation and diversified portfolios. Others argue it reduces competition because the same investors own competing companies in every industry: airlines, banks, technology platforms, pharmaceutical companies. If you own all the competitors, you don't necessarily want them to compete aggressively. The debate isn't settled, but the concentration is undeniable. 5 institutions control the infrastructure. 3 asset managers control the voting power. And all of it is interconnected through the custody and clearing systems that make modern finance possible. Now consider what happens during a crisis. In March 2020, when COVID-19 shut down the global economy, financial markets seized up. Corporate bond markets froze. Liquidity vanished. Even U.S. Treasury markets, supposedly the safest and most liquid in the world, experienced severe dysfunction. The Federal Reserve responded with overwhelming force. It cut interest rates to 0. It launched $700 billion in quantitative easing. And critically, it established emergency lending facilities to provide liquidity directly to primary dealers and money market funds. But the real stress point was in the clearing and settlement systems. As prices crashed and volatility exploded, clearing houses demanded more collateral. Margin calls surged. Firms scrambled to meet obligations. The entire system came within hours of a cascading failure, where one default would trigger another, spreading through the interconnected network of obligations. The clearinghouses held. DTCC processed near-record volumes without breaking. Euroclear and Clearstream continued operating. State Street and BNY Mellon managed trillions in asset flows. The infrastructure survived. But it survived because central banks flooded the system with liquidity, because regulators suspended certain capital requirements, because the institutions themselves had built up massive capital buffers after the 2008 crisis. The system didn't fail because it was backed by the full faith and credit of governments. This raises the fundamental question: are these institutions private companies or public utilities? Legally, they're private. DTCC is owned by its member banks and brokers. Euroclear is owned by financial institutions. State Street and BNY Mellon are publicly traded corporations with shareholders. But functionally, they operate as infrastructure. They provide services that the entire economy depends on. They're regulated like utilities in many ways. They're subject to oversight by the Federal Reserve, the Securities and Exchange Commission, the European Central Bank, and other regulatory bodies. And when they face existential threats, governments step in to protect them. This creates moral hazard. If an institution knows it's too important to fail, what incentive does it have to manage risk conservatively? If losses will be socialized, but profits remain private, why not take more risk? Regulators have tried to address this through capital requirements, stress tests, and recovery and resolution planning. After 2008, DTCC was designated a systemically important financial market utility under the Dodd-Frank Act. This gave the Federal Reserve direct oversight authority and required DTCC to maintain higher capital buffers. In Europe, the European Market Infrastructure Regulation imposed similar requirements on clearinghouses and central securities depositories. The goal was to make these institutions resilient enough to withstand extreme stress without government bailouts. But the underlying problem remains. The more essential an institution becomes, the more concentrated the system gets. And the more concentrated the system gets, the more essential each institution becomes. It's a feedback loop that reinforces itself. Some have proposed alternatives: distributed ledger technology, blockchain-based settlement systems, peer-to-peer clearing without central intermediaries. The promise is that technology could decentralize the infrastructure, reducing concentration and systemic risk. But nearly 2 decades after Bitcoin launched, the financial system still runs on the same centralized architecture. Why? Because centralization is efficient. It reduces counterparty risk. It enables netting and collateral optimization. It provides legal certainty and regulatory oversight. All the things that make distributed systems theoretically attractive, speed and decentralization, create practical problems in a world where transactions need finality, disputes need resolution, and fraud needs prevention. So the concentration continues. In 2006, DTCC processed $1.86 quadrillion in securities transactions. By 2023, that number had grown to $2.5 quadrillion. Euroclear's assets under custody have grown from $20 trillion in 2010 to $38.4 trillion in 2024. State Street and BNY Mellon's combined custody assets have grown from $40 trillion in 2008 to nearly $93 trillion today. Every year, more assets flow through fewer institutions. Every crisis proves these institutions are essential, and every regulatory response to make them safer also makes them more entrenched. There's a deeper pattern here. Throughout history, financial systems have oscillated between fragmentation and consolidation. Before the 20th century, banking was local, thousands of small institutions serving regional economies. Then came consolidation. Economies of scale, national banks, too big to fail institutions. The 2008 financial crisis accelerated this trend. Lehman Brothers, Bear Stearns, Washington Mutual, and hundreds of smaller banks disappeared. The survivors got bigger. JP Morgan Chase acquired Bear Stearns and Washington Mutual. Bank of America acquired Merrill Lynch. Wells Fargo acquired Wachovia. The 4 largest banks in the United States now hold $8.9 trillion in assets, 40% of all bank assets in the country. But the consolidation in clearing, settlement, and custody is even more extreme. Because these functions benefit so directly from network effects, there's no natural limit to concentration. The biggest node in the network is always the most valuable. So capital, participants, and transactions all flow toward it. This creates institutions that are simultaneously incredibly powerful and incredibly vulnerable. Powerful because they control essential infrastructure. Vulnerable because any disruption to their operations disrupts the entire system. Consider what would happen if DTCC's systems went down for a week. Not from a cyber attack, not from malice, just a catastrophic technical failure. Every stock trade in America would stop settling. Brokers couldn't deliver securities to buyers. Cash couldn't flow to sellers. Margin requirements couldn't be calculated. The entire equity market would freeze. Regulators have required these institutions to build redundancy, backup systems, disaster recovery protocols. But redundancy has limits. If the primary system and the backup system run on similar architecture, they share common vulnerabilities. If they're both protected by the same cybersecurity measures, a sophisticated attacker might breach both. And there's a more fundamental problem. These institutions are so large, so complex, and so interconnected that even they may not fully understand their own vulnerabilities. After the 2008 crisis, the Federal Reserve conducted stress tests on the largest banks. The goal was to determine whether they could survive another severe recession. But the stress tests could only model risks they could anticipate: liquidity crunches, credit defaults, market crashes. What they couldn't model was the cascade of second-order effects that emerge when multiple institutions face stress simultaneously. When clearinghouses demand more collateral, when custody banks restrict lending, when settlement systems delay transactions. When all of this happens at once, feedback loops emerge that no model can predict. The financial system has become so complex that it may be unknowable. not because information is hidden, but because the interactions between components create emergent behavior that can't be understood by analyzing the components individually. This is the shadow banking empire, not a conspiracy, not a cabal of evil bankers plotting to control the world, just a system that evolved through rational choices, network effects, and regulatory responses to past crises. A system that has become so efficient that it's fragile, so interconnected that it's vulnerable, so concentrated that it's irreplaceable. 5 firms control $50 trillion in daily flows. They hold more than $150 trillion in custody. They settle more than $2.5 quadrillion annually. They process every stock trade, every bond issuance, every derivatives contract that makes the modern economy function. You've never heard of most of them, but they've seen every financial decision you've ever made, every retirement contribution, every stock purchase. Every transaction that touches the markets flows through their systems. And the question isn't whether this concentration is good or bad. The question is, what happens when the infrastructure that holds the entire system together becomes the system itself? When private institutions provide public goods, when efficiency creates fragility, when the institutions that are too big to fail become too big to save. Because the next crisis won't announce itself. It won't wait for regulators to prepare. It will emerge from some unforeseen corner of the system. A technical failure, a cyber attack, a cascade of margin calls. And when it does, the institutions that control $50 trillion will have to hold. The system depends on it. The economy depends on it. Your savings depend on it. So here's the question we should be asking. In a world where 5 institutions control the infrastructure of global finance, where concentration is inevitable and decentralization is impractical, where efficiency demands centralization and centralization creates systemic risk, what happens when the center cannot hold?